What's up, Hector?
Hey, what's up, man?
Oh shit, my sound was off. Can you hear me out there?
Yeah,
Awesome, cool. I can hear you. How you doing, man?
I'm good, good.
Good. We'll give it probably like 2 more minutes and then we'll go ahead and get started. So,
What's up, Chris?
what's up, Lee? How are you, man?
I was trying to freaking stay sane through this June. Freaking crazy, man, already.
Are you doing a lot of shows, like traveling around with a lot of shows and things right now?
Oh, I got like Westoneers, the horses. I got three of those a week, and then I got
Woo!
my other business I do on Wednesdays, and I gotta like make shirts for that. It's just and then the real estate stuff. So it's just crazy, man,
Just
nonstop.
a just a nonstop grind, but hey, that's better that way. I mean, we can all sleep when we're dead and get to the grind now while we can.
Very true. But yeah,
Awesome. Well, I think we'll go ahead and get started here, guys. So, welcome to another round of Be the Market Expert, where you guys are now being the expert of the market just by hopping on this class. So, I'm gonna go ahead and share my screen. All right. And you should be able to see that now. All right, guys. So we're going to start with the typical Logan article that I always start with. So this week he's saying housing demand stays positive with mortgage rates near 2026 highs. So, as we dive into this, we'll go ahead and just dive right into weekly pending sales. But ultimately, what he saw with the weekly pending sales this week, we did notice a strong rebound after the holiday-related slowdown. So this week we're at 75,935 pendings versus last year is 69,636. So we are seeing a year-over-year increase there. And obviously, again, that snapback was probably largely expected from the Memorial Day weekend, which temporarily softened the activity. Now, what this ultimately means, now, obviously, this is, something to keep in mind. Pending sales is typically like a forward-looking indicator. We have about 30 to 60. days to keep that in our back pockets there. So the encouraging news that we're seeing though is that buyers are still writing contracts despite the mortgage rates are sitting much closer to this year's highs than lows. Now, again, what we are seeing there, let me gotta love when I mess this up. Nice. I don't even know what I did here. There we go. All right. Sorry, technical difficulties there. All right. So again, what we are seeing with the pending sales, obviously the rate factor still matters. So over the past several years, we've kind of consistently seen that the housing demand softens when mortgage rates are above that six, or are above that 6.64%. And then even more pressure when the rates get above 7%. But on the flip side of that, the demand tends to strengthen when we see the rates go below 6.64 and trend closer to the 6%. So while this week's rebound is encouraging, rates are still going to remain the biggest factor that we want to watch moving forward. Now, what we can take away from the pending at least is obviously that the buyer demand remains present even in a higher rate environment, and we want to watch those mortgage rates closely over the next few weeks. So buyers are still stepping off the sidelines, proof that the demand remains alive even as mortgage rates hover near their highest levels of the year. So now, as we dive into another forward-looking indicator, the mortgage purchase application data, what we're seeing here is that the mortgage purchase applications did decline 3% week over week. So we did notice a decrease there, but it's still 7% up year over year. So despite the higher mortgage rates, overall buyer demand remains stronger than it was at this time last year. So again, I mean, with this thinking that this is, 30 to 90 days out, these are people that are putting applications in. Um, what happens in purchase apps today often shows up in pending and closed sales over the next few months. So ultimately, what we're kind of looking for here, or what we want to see here, is 12 to 14 weeks of consecutive positive week to week growth. And then when we get both the positive weekly momentum and the positive year over year growth, that's when we typically see that the housing demand is truly accelerating. And we're not there yet. 2026 has obviously been more of a tug of war if we kind of look at what we've seen over our last few weeks. What we've seen is 9 positive, 10 negative, 2 flat weeks, 9 weeks of double-digit year-over-year growth, 19 weeks of positive year-over-year growth, and 2 negative year-over-year prints. So the story is pretty clear there, I would say, that the weekly momentum has been mixed, but year-over-year demand has remained positive for most of the year. So what we can kind of take away from this is obviously these are still a great way and remain one of the best indicators of future sales activity. And the buyers are still active again, even with the elevated rates. So we'll watch this closely as we do every week, just to kind of see where it goes. We'll skip over mortgage spreads and 10-year yield, and we'll move right into housing inventory. So housing inventory, it did post its expected rebound following the Memorial Day slowdown. So we did see that rebound. So the weekly change, it did increase. We went from 795 or from 795,000 to 806,000. And then the same week last year, we rose from 803,000 to 808,000. So despite the weekly increase, inventory remains slightly below last year's levels. If we look at the graph here, we are just underneath. So what this means, the inventory growth that we saw this week is largely kind of a return to normal after the holiday disruption. But more importantly, while year over year inventory has slipped into slightly negative territory, today's inventory levels remain dramatically healthier than the ultra light, ultra tight conditions that we experienced from 2020 to 2023. So that is an important distinction here. Obviously, we are still significantly over all of these years down here. A negative year-over-year comparison sounds concerning in a headline. Obviously, we see those headlines everywhere, but the market is operating from a much stronger supply position than it was during the pandemic era housing frenzy. Um, so again, something to kind of focus on with the inventory here is don't focus solely on the negative year-over-year comparison. Inventory levels today, again, are still significantly healthier than the pandemic era. And then more inventory does create more opportunities for our buyers while keeping the price growth in check. So a balanced market is obviously often a healthier market. As we move down to new listings, so again, new listings bounce back as well. New listing activity increased to 76,766 from year over year, 73,436. So this puts the new listings ahead of last year's pace, which is a healthy sign for overall market bounce. The sharp drop we did see after Memorial Day was never expected to last. And now we're seeing a more normal season rebound as more sellers bring homes to the market, heading into the heart of the summer. So, just that typical spring market that we see, and that's a positive development. So, more listings mean obviously again more choices for buyers, more opportunities for agents, and a healthier, balanced marketplace. Now, bigger picture here, what we're looking at historically, the seasonal peak years of 2013 to 2019. We typically see the new listings at 80,000 to 100,000 per week during this spring market. We're not fully back to those levels yet. I know like 2 weeks ago we did get up there, but we're not quite there again. Now that gradual return toward normal inventory levels is definitely one of the healthier trends that we've seen this past year. Now, something I did want to address here, let's address the housing crash narrative. Every time new listings rise, some people immediately ask, is this starting to look like 2008? The data says absolutely not. During the housing bubble crash years, new listings routinely ranged from like 250,000 to 400,000 per week, and those were persistent for years. Obviously, we're not seeing that. So by comparison, even if we doubled what our today's new listing numbers would be, we still wouldn't reach those seasonal lows from that era. Um, Again, this is just a normalization. So as we dive down to price cut percentage, what we're seeing with price cut percentage is that they remain very close to the historical norms. We're at 37.53%. Last year was 39%. And the percentage of homes reducing their price is slightly lower than last year, which is kind of continuing the trend that we've seen pretty much this whole year. Now, keep in mind, typically about one third of homes will experience a price reduction before they sell, so 33.33%. And that's not a sign of a struggling market. It's simply just part of the normal price discovery process between buyers and sellers. What's notable this year that we've seen, mortgage rates are rising, affordability challenges we've definitely seen, and more inventory than recent years for sure. So the price cut activity has remained remarkably stable. Now, the surprising part of that is many analysts did expect the price cuts to increase more noticeably as rates moved higher this spring, but that really hasn't happened. And actually, in fact, we've actually seen this week's data has came in lower than what many would have expected given the recent rise in mortgage rates. So the fact that the price cut percentages remain below last year's level suggests buyers are still active enough to keep sellers from making significant pricing concessions. Now, what that ultimately means before we dive into the next article here, if we're going to take anything from the price cuts, is that again, remember price cuts are normal and they should be expected in every market. Proper pricing does still matter more than ever. So having those conversations with your sellers beforehand so you don't get into the whole chasing the market and then trying to figure out how much should we reduce by blah, blah, blah. It's not a fun game to play. You just want to have these conversations up front with your sellers so that they're aware of where the market's at, and the market's going to tell you if you're too high. It's pretty straightforward there. So, sellers who price realistically are still going to find buyers, and then the market remains far more balanced than many headlines would suggest, which is the whole point of being the market expert. So, even with the higher mortgage rates, sellers are not cutting prices dramatically, a sign that housing demand remains stronger than many expected. All right. So we're going to dive out of that one. And then we've got another article here. Now, this is first-time buyers are the missing link in today's market. So this is an article by Eric. And ultimately, what this kind of talks about is that first-time buyers now make up just 21% of home purchases, the lowest share on record. Historically, first-time buyers have represented closer to 40% of the market. So this isn't simply a mortgage rate issue, it's becoming a structural challenge that is impacting transaction volume across the entire housing market. So why are they struggling? Why are first-time buyers having issues out here? Well, a repeat buyer often brings, uh, well, let's say this. Today's first-time buyers do face a very different reality than repeat buyers. So a repeat buyer is oftentimes going to bring significant home equity, large down payments, more financial responsibility, and the ability to buy down rates. A first-time buyer is typically going to bring income, savings, limited assets, and no equity cushion. So what's the challenge? The income needed to qualify for a median priced home has roughly doubled since 2020, while the wages haven't kept that same pace. At the same time, home prices do remain elevated, down payment targets keep growing, and affordability remains stretched. For many first-time buyers, homeownership feels further away than ever. Now, why this affects the entire market? The housing market, obviously, it's a hyper local, market that we always have to look at the hyper local statistics and data. But the housing market does function like a chain. So when a first-time buyer can't purchase a starter home, the starter home seller can't move up. Then the move up seller can't buy their next home, and the chain of transactions slows down. So one missing first-time buyer can eliminate multiple transactions from the marketplace in the grand scheme of things. So that's a big reason why transaction volume remains well below historical norms, even though home prices have remained relatively stable. Also, at the same time, many existing homeowners have mortgage rates below 4%. So they face a difficult decision. Should I stay in the home with a historically low rate, or should I move and take on a mortgage that's closer to 6.5% plus? And most are choosing to stay put unless if life happens. Now, this creates pressure from both sides. Existing owners are reluctant to sell, and we're also seeing the first-time buyers are struggling to enter. The result is a market that kind of feels stuck, not because nobody wants to move, but because fewer people can. But the price isn't necessarily telling the whole story. So one of the best points in this article is that volume matters more than price right now. Home prices often grab headlines, but transaction volume tells us how healthy the market really is. And today we're seeing limited inventory, reduced affordability, lower transaction volume, and fewer first-time buyers entering the market. That combination is obviously slowing the market movement far more than pricing alone would suggest. Now, what does this mean for us? The article highlights something we've been talking about for months. The issue isn't that buyers disappeared. They're still around. It's that the buyers the market needs most are having the hardest time getting in. The agents who understand this challenge and can help solve it and create opportunities where others see obstacles are going to win. Because every first-time buyer who successfully purchases a home helps unlock multiple transactions throughout the market. So the reason I brought this one up is there's still an avenue out there for first-time buyers. Obviously, when we talk to some of our lender partners, there's creative financing ways that we can help them get in. And a lot of the times they're more so scared because they're seeing the headlines rather than actually understanding what's going on, what's going into or getting the ability to afford a first-time home. And so we need to have these conversations with those buyers. First-time buyers aren't just missing from the market, they're the foundation that helps the rest of the market move, and we have to remember that. All right. Next one. Now, this one was kind of interesting. So this is a better Coinbase fund Fannie Mae backed Bitcoin mortgage. So what's happening in this article essentially, again, creative financing. So Better Mortgage and Coinbase announced that they have funded what they say is the first Fannie Mae backed mortgage that uses Bitcoin as collateral. The program is expected to expand nationally this summer. Instead of selling crypto assets to fund a down payment, eligible borrowers can pledge digital assets as collateral while maintaining ownership of those investments. So, how does that work? Well, traditionally, a buyer with significant cryptocurrency holdings would need to either sell some of their Bitcoin or other assets, they need to pay potential capital gain taxes, or they convert those assets into cash for a down payment. Under this new program, borrowers can use qualifying crypto assets as collateral without liquidating them. Initially, the program does support Bitcoin and it supports USDC, I believe is what it's called. Yep. Which is considered a stable coin, with plans to potentially add additional digital assets later. Now, why does this matter? This is less about cryptocurrency and more about how wealth is changing. Many younger buyers today have accumulated wealth through stock investments, tech compensation, digital assets, and alternative investments. But traditionally, mortgage underwriting is historically focused on cash savings and bank accounts and conventional assets. So this program is essentially attempting to bridge that gap. Now, the first borrower story, the first loan reportedly went to a married couple in their early 30s who were purchasing their first home. And instead of selling their Bitcoin holdings to create a down payment, they used those assets as collateral and preserve their investment position. For some buyers, that could be a very meaningful advantage. Now, the bigger housing story on this is that one statistic in this article stands out. So 41% of bettors pre-approved buyers qualify based on income and credit, but don't have enough cash available for a traditional down payment. That's a huge challenge that we see in this market, obviously. But at the same time, the median first-time buyer age has reached 40, home prices remain elevated, and saving for down payments continue to get harder. Programs like this are attempting to solve part of that affordability puzzle. So what does this mean? Well, if you're bullish on crypto or not, this represents another example of housing finance evolving, another creative financing thing that I was just talking about. Just like we've seen, rate buy downs, down payment assistance, shared equity programs, even alternative lending products. Lenders are exploring new ways to help qualified buyers access home ownership. So, from our perspective as our KW agent, this won't apply to most buyers today, obviously. However, it does highlight a trend agents should be watching. Mortgage products are becoming more flexible and creative. As agents, we don't need to become crypto experts. I'm not saying go out there and learn everything about Bitcoin because I'll be the first to say I don't know anything about it. Other than I wish I would have invested back when they first started. But we do need to stay informed about these evolving financing options because the next generation of buyers may have wealth that looks very different from previous generations. And if you've been on this call consistently, you'll know that because we've talked about all those consistent or different creative financing options. We've talked about the different ways that different generations are purchasing homes and how just the whole home buying process in general is kind of switched around from generation to generation. So ultimately, I wanted to just bring this one up. The future of home financing may not be about how much cash a buyer has in the bank, but it may be about how many different forms of wealth lenders are willing to recognize, and that's a huge battle that could play in everybody's favor down the road. All right, now this is an Inman article. Learn how to read the real estate market's vital signs. So I wanted to bring this up just because I think there's some good pieces in here, especially as we're trying to be the experts of the market here. So what's happening is a recent headline grabbed attention by reporting that the largest national list price decline in 9 years, with the median list prices down 2.4% year over year. And obviously on the surface, that's going to sound alarming. But as this article points out, a single headline rarely tells the whole story. The mistake many people make is that consumers often see a headline like the biggest home price drop in 9 years, and they immediately assume the market is crashing. But great agents like you guys who are here know that a headline is a symptom. It's not a diagnosis. Just like a doctor would make a diagnosis from a single vital sign, we shouldn't evaluate the housing market from one data point. We want to get in and understand it all. We want to have a better knowledge around everything. So, what the rest of the data says when you look at beyond the headline, several encouraging trends emerge. Price cuts are actually declining, so price reductions fell from 19.1% to 17.5% nationally. Sellers aren't panicking. More sellers are pricing appropriately from the start, just like we need to have those conversations with our sellers. Pending sales are rising, so the pending sales did increase 4.3% year over year, which does mark the sixth consecutive months of growth. And then buyers are still actively entering the market, as we've seen with purchase application. New listings are increasing. Obviously, we're seeing that new listings have reached their highest May level since 2022. More inventory means more opportunities for buyers, and it also creates a healthier and more balanced marketplace. So when you combine the slightly softer prices, more inventory, rising pending sales, and fewer price cuts, we're not getting a crashing market. We're getting a market that's normalizing. And it's the same thing that we've talked about week over week. Buyers do have more choices. Sellers still have opportunity and transactions are still happening and they're going to continue to still happen. That's a far healthier environment than the frenzy we experienced a few years ago. So the opportunity for agents is simple. This article really isn't about housing data. It's about agent value because clients are reading the same headlines that we are, but they don't have the knowledge that we have. When they see the scary news, they need someone who can explain what's actually happening. They want to know what's the noise about, what's meaningful, and what it means for their situation specifically. The agents who can provide perspective definitely will become the trusted advisors. As far as takeaways for sellers, price it correctly from the start. Today's buyers are active, but they're also informed. The days of simply throwing a number on the wall and hoping it sticks are gone. For buyers, many have been waiting for better conditions. Today, they have more inventory, less competition, and more negotiating opportunities. So, trying to perfectly time the market often means missing all opportunities altogether. For us as agents, know your local numbers. National headlines don't sell homes, local expertise does. One of the most valuable things we can provide right now to our clients is perspective. While the headlines are definitely there to chase clicks, our job is to interpret the full story. Because when clients understand what's really happening, they make better decisions. And when agents consistently provide clarity, they're going to earn the trust of their clients. So the best agents don't react to the headlines, they read the market's vital signs and they help their clients do the same. Now, another Inman article here. May home sales soared. Pending contracts tell a different story. So, what's happening in this one is existing home sales jumped 2.8% in May, reaching their highest level since October of 2022. At a first glance, sounds like the housing is really accelerating. However, pending sales, which measure newly signed contracts, rose only 1%, signaling much slower momentum moving forward. So why do the numbers seem so contradictory? Well, the key is understanding, again, keyword understanding, the difference between closed sales and pending sales. So closed sales, these reflect decisions buyers made 30 to 60 days ago. May's strong sale numbers were largely driven by buyers who locked in contracts during April when mortgage rates briefly dipped closer to the 6.3%. Pending sales reflect what the buyers are doing right now. By May, mortgage rates climbed back toward their recent highs, reaching nearly 6.8% before slightly easing. And as rates increased, buyers' activity slowed. Mortgage rates do still remain the story ultimately. Now, this article does reinforce something we've discussed almost every week this year. Housing demand is incredibly sensitive to the mortgage rates. When the rates moved lower, buyers stepped in, contracts increased, and closings followed. But when the rates moved back up, pending sales flattened, mortgage applications softened, and demand cooled. The market continues to prove that affordability, not desire, is going to be the biggest challenge. Now, one interesting takeaway that with this article, even with the higher rates, the slower pending sales, and the buyer affordability challenge, the inventory reached a 6-year high. And yet, home prices still rose 2% year over year. More listings entered the market, and the percentage of the homes selling below list price has declined for 6 consecutive months. Definitely doesn't sound like a market in distress. What it does mean, though, is the housing market is sending a mixed but understandable message. The good news is, again, buyers are still active and they're still out there. Life happens to them, so they still have to move. Inventory is improving. Well, obviously, we're seeing that on a hyperlocal and a national level, and then prices do remain stable. So the challenge again is the higher rates continue to limit how many buyers can participate. Um, Now, the other thing that this article mentions is that, again, local markets matter more than ever. This article does highlight the differences in kind of like how different markets are behaving. So what we're seeing is San Jose, it was an increase in 25.7% sales growth. San Francisco was an increase of 19.3% sales growth. However, then you have Detroit, who is a decrease of 14% sales decline, and you have New York City, who's a decrease in 9.1% sales decline. So the national story matters, but again, real estate will always remain hyper local. The takeaway for us as agents here is that this article is just a great reminder, again, not to be fooled by one headline. When the clients hear home sales just surged, the follow-up question that we should have is, are we talking about closed sales or pending sales? The strongest agents understand both the rearview mirror and the windshield. They're going to understand how to differentiate both pending sales versus closed sales. Again, to keep that in mind, closed sales tell us where we've been, pending sales will tell us where we're going. And right now, the market is still moving forward. But again, mortgage rates do remain the biggest factor determining how fast we move forward. All right, now I got one more here for you. This is the New York Times because I thought this one was kind of funny. Can I trust the Zestimate for my home on Zillow? Now, this is just a quick interview article essentially, but ultimately, what's happening with this one? A homeowner questioned why Zillow valued their home at 1.2 to 1.3 million when comparable homes were selling between 800 to $900,000. That's a pretty significant variance. Even after submitting additional information to Zillow, this estimate actually increased rather than decreased. So the situation highlights a question many homeowners do ask because they have Zillow at their fingertips. How accurate is this estimate? Well, on Zillow's side of things, Zillow describes its estimate as a neutral estimate of a home's market value based on available data. This estimate uses public records, tax records, MLS data, previous sales history, property characteristics, and homeowner submitted information. According to Zillow, off-market homes have roughly a 7.2% error rate, but active listings have roughly a 1.74% error rate. Now, the key phrase is it's only as good as the data going into it. The problem with automated valuations is that this estimate is great at identifying patterns. It's not great at understanding things like unique floor plans or deferred maintenance or renovation quality, location nuances, busy streets versus quiet streets, the views that you have, and even the neighborhood micro markets. So two homes can look identical on paper and have dramatically different market values. And that's where the algorithms struggle. So his estimate is best viewed as essentially a starting point. It's not an appraisal. It's not a CMA like we can get for our clients. It's not a professional valuation. This estimate can be too high, it can be too low, or sometimes it can even be surprisingly accurate. But that's the thing is you don't really know. It should never be the only number that's used to determine a value. Now, why this matters for our consumers or clients, this article I think reinforces one of the biggest opportunities agents have today. Consumers often arrive to us and they say, Zillow says my home is worth this. But the real conversation should be, let's look at what buyers are actually paying for similar homes right now. Because markets move, algorithms lag, and again, local expertise win. So what does that mean for us as agents? Well, this is again a perfect example of how we can provide value. As estimate cannot walk through the property. They can't assess the condition. It's not going to understand the upgrades or, interpret the local buyer behavior. And it's definitely not going to evaluate neighborhood trends. But we can do all of those things. In today's market, where pricing strategy matters more than it did during the frenzy years, the expertise becomes even more valuable. So don't fight with this estimate. Use it as a conversation starter. Help your clients understand what Zillow sees and what the market sees and why those two numbers are not always the same. Because ultimately, homes don't sell for what Zillow thinks they're worth. They sell for what a qualified buyer is willing to pay. And ultimately, as estimate is a useful estimate, keyword estimate, but it's not a valuation. The market determines the value, and that's where professional guidance still matters most. All right. So before we just finish off here, I did want to dive into our local market. So for those of you that were last week, you'll remember some of these numbers. But last week's new listings, we were at 1,633. This week, we are at 1,702. So we did see a slight increase there. Coming soon, we were last week at 270 and we've dropped down to 253. So what, a 17 home decrease there. Back on market last week was 314. We're at 307 this week. So just a slight decrease there. Price decrease. We saw last week we were at 2,367. Price decrease this week is 2,202. Pendings last week was 1,448, which we've seen a small decrease there at 1,393. And then closed, we did see somewhat of a significant decrease. Closed last week was 1,633. This week we're at 1,122. So if I can leave you guys with one more little final takeaway or one lesson from this week's articles, the housing market again is proving to be far more resilient than any of the headlines out there want you to believe. Again, those are there for clickbait. This week we discussed inventory turning slightly negative year over year. We saw that the pending sales rebounded after a holiday slowdown. We saw that the purchase applications stayed positive over year. New listings continued to improve. Price cuts are remaining stable, and first-time buyers are facing real affordability challenges. That hasn't changed for a few weeks, obviously. New financing innovations like Bitcoin-backed mortgages we saw. And then we also talked about why his estimate should never replace local expertise. So at first glance, those topics kind of seem disconnected, but they're all actually telling the same story. It's not a crashing market. Again, I can't stress that enough. It's normalizing. We're no longer in the frenzy of 2021. We're not in the panic of 2022, and we're definitely not in the uncertainty of 2023. Instead, we are moving into a market that rewards knowledge, strategy, professional guidance, and even real conversations. And honestly, that's where us as great agents are going to thrive. Consumers now need more guidance than ever. The first time buyers need help navigating affordability. The sellers need help understanding realistic pricing. Our homeowners need help separating online estimates from actual market value. Buyers need help understanding whether waiting actually improves their situation. The common thread, people need trusted advisors. And so again, where we're going to win right now is not by predicting rates. It's not by predicting the next headline, and it's not by trying to time the market. It's going to be by understanding the data, explaining the trends, creating confidence, solving problems, and staying consistent. Every transaction this year is being won by the professionals who can provide clarity when everyone else is providing noise. The opportunity ahead, the market may not be easy, but it is active. Homes are selling, buyers are buying, sellers are moving, builders are investing. We talked about that last week. Lenders are innovating, and major companies are continuing to bet billions on the housing market. That's not what a dying industry looks like. So, if I can leave you with one last line, the market isn't waiting for perfect conditions to move forward. It is moving right now. And the agents who stay informed, stay consistent, and continue leading their clients with confidence will be the ones who win. All right, guys, I appreciate you hopping on here for another week of Be the Market Expert. I hope you all have a great week, and please reach out if you guys have any questions on anything.
Thanks, Chris. Appreciate it.
Thank you, Chris. Appreciate it.
Have a good
Thank
week.
you, guys.
That
Have a
was
great week.
great. Thank you.
Thank you, Greg.